Hi, today we're presenting Group 4's financial analysis report examining Shopify, an e commerce platform that helps businesses of all sizes sell physical and digital products. The information covered in this presentation will provide you with a review of strategies and financial analysis to get insights into the company's performance over the last 3 calendar years. This presentation considers the company's capital structure, dividend policy and history, and cost of capital in order to understand its value as perceived by its creditors and investors. All financial figures to be mentioned are expressed in US dollars. This report will cover 5 parts. Anna will begin with a company background and financial overview, where a basic qualitative and quantitative description of the company will be the focus. Afterward, Joy will discuss Shopify's liquidity and solvency, tackling topics like working capital and debt and equity. I will then go over the company's asset management and profitability, highlighting Shopify's asset turnover and net profit margins. Then we will move on to a frame who will talk about market value measures and dividends. And the last segment will include risks and returns, as well as a conclusion, which will be presented by Christy. Anna?
Good day. I am Anna Marinilia, and I will be discussing on the company history and financial overview of Shopify. Shopify is an Ontario-based e-commerce company founded in 2004 by Tobias Lutka, Daniel Waynon, and Scott Lake. The company quickly grew to be one of the largest e-commerce platforms in the world, getting 11% market share and 1,300% market growth. And today, millions of sites, businesses, and enterprises avail of their services. The company has merchants located in 175 countries across the world, which contribute to their massive $133 billion market capital. Those using Shopify software have the freedom to operate and manage their online store. Thanks to it being a cloud-based software, merchants do not need to maintain it themselves. Additionally, Shopify offers multiple business plans to cater to enterprises of different sizes. Shopify faces major competitors. BigCommerce is an e-commerce software with robust features and payment gateways, making them better for big or growing businesses. WooCommerce is an e-commerce plugin for WordPress website. It is free to use, open source, and has access to multiple free and paid extensions. Magento is an e-commerce platform with a large network of developers creating additional functionality for the platform and allows enterprises to opt for cloud-hosted or self-hosted solutions. Pinnacle Art is a solution aimed towards smaller businesses with an emphasis on marketing and provides additional search engine optimization features. Shift for Shop is a software focusing on search engine optimization tools for cheaper prices than Shopify. This makes it more appealing for very small businesses. Wix is a website builder with intuitive drag and drop features. With this, it is very easy to build an online store, also offering premium plans and website domains. On the next slide, we have Shopify's financial overview. The financial overview assesses the company's financial statements, such as the balance sheet, which measures the company's financial position, the income statement, which measures the company's performance, and the statement of cash flows, which shows the cash generated and used by the company from its various activities, namely operating, investing, and financing. Looking at the financial position of the company, we can say that Shopify is a highly liquid company with 89% of its assets classified as current in 2021. In addition, Shopify is slightly leveraged or under-leveraged since more than 80% of its financing is coming from the shareholders. In terms of the performance of the company, 2021 was an outlier with net income of 63%. This is a huge jump from 2020's net income of 11%. For the cash flow, we analyzed the sources and the uses of cash based on the nature of activities of the company. Looking at the waterfall chart, we can say that most of the cash flows of the company is coming from the investing activities and most of the inflows are coming from the financing activities. In other words, most of the expansion activities of the companies are funded by additional investments from shareholders instead of reinvestment of cash flows from operating activities. To discuss Shopify's liquidity and solvency, we have Joy Chang. Hi, Joy. Now over to you.
Okay, hello everyone. My name is Joey Chan. So now I'm going to talk about Shopify's liquidity and solvency ratios. Let's first take a look at the working capital and current ratio. There are two metrics to measure a firm's ability to fulfill its short-term liabilities. First, let's take a look at the net working capital. It is the difference between short-term asset and short-term liabilities. For Shopify in 2019, it has 2,742 million net working capital. And in 2020, it jumps up to 6,878 million. This reveals in 2020, Shopify, as we mentioned earlier, has really booming years in 2020 due to the impact of pandemic and the change in consumer behaviors. In last year, its net working capital also jumped up to 8,539 million. This also shows Shopify definitely has more than enough ability to realize its short-term liabilities. Now let's move on to current ratios. For current ratios, in 2020, it's 15.7. So as compared with one of its big competitors, Amazon, only have 1.2. This also means Shopify has more short-term assets than its competitors and industry average, which means could possibly raise up another concerns is that Shopify didn't invest or reinvest cashes into other projects or capital expenditures. So now let's look at the working capital to total assets. So in 2019, it's 59%. And 2020, no doubt again, because of the booming years, the net working capital jumped up to 83% in 2020. On the other hand, let's take a look at debt and equity. So first, let's look at the equity multiplier. So equity multiplier is total asset divided by total equity. So Shopify's equity multiplier is 1.20 in last year. This shows the majority of its total asset is financed by its equity. So since May 2020, Shopify has tapped the equity markets on 3 occasions in an effort to try to take advantage of this attractive equity market and execute an ambitious growth targets. Most recently, in February 2021, it raised up to 1.55 billion. And in September 2020, Shopify issued 1.265 million shares and at $900 per share. And in May 2020, it issues about 2.128 million shares and with $700 per share. Let's look at the time interest rate earned and cash coverage. Because of its profitable year in 2021, its interest earned is up to 900. This shows Shopify generates significant amount of income to pay back its interest expense, which also means its income is 900 times greater than its interest expenses. Shopify looks to reinvest its build-out and fulfillment network and international expansions. So we believe that the change behavior adopted by merchants and consumers and has improved the prospects for entrepreneurship and digital commerce. As a result, Shopify seems to have a promising years when we examine its solvency and the liquidity ratios. Okay, thank you so much. That's my part. So now let's welcome Jeniel for introducing Shopify's asset management and profitability. Thank you.
Hi, I'm Janelle and we'll talk about asset utilization turnover. Let's start with the receivables management. The receivables turnover measures the efficiency with which a company is able to collect on its receivables or the credit it extends to customers. It measures how many times a company's receivables are converted to cash in a certain amount of time. It's important for investors to compare the accounts receivable turnover of companies within the same industry to get a sense of the average turnover ratio for that sector. If one company has a higher receivables turnover than the other, then it may be a safer investment. A high receivables turnover can indicate that a company's collection of accounts receivable is sufficient and that it has a high proportion of quality customers who pay their debts quickly. On the other hand, a low turnover isn't a good thing. It may suggest an inadequate collection process, bad credit policies, or customers that are not financially viable or creditworthy. A low turnover typically implies that a company should reassess its credit policies to ensure the timely collection of its receivables. Looking at Shopify's numbers, their receivable turnover slightly increased in 2021, which means that the average time it takes for them to convert their receivables to cash has slightly increased. It'll be good to track these numbers in the coming periods to determine if a trend or pattern is developing over time. Shopify can correlate the collection of receivables to earnings to measure the impact of the company's credit practices on profitability. Next are asset turnover and net working capital. The asset turnover ratio tells how much sales a business is generating for every dollar spent or invested in asset. Investors also use this metric to compare similar companies in the same sector or group. This gives them and the creditors an idea of how companies are managed and use their assets to produce products and sales. The higher the asset turnover, the more efficient a company is at generating revenue from its assets. Conversely, if a company has a low asset turnover, it suggests that the business may not be efficiently using its assets to generate sales. A lower result indicates poor efficiency, which may be because of poor usage of fixed assets, poor collection methods, or poor inventory management. Working capital turnover measures how efficiently a company is using its working capital to support sales and growth. It measures the relationship between the funds used to finance a company's operations and the revenues a company generates to continue operations and turn a profit. A high turnover ratio allows that management is very efficient in using a company's short term assets and liabilities for supporting sales. In other words, it is generating a higher dollar amount of sales for every dollar of working capital used. Now, in contrast, a low ratio may indicate that a business is investing in too many accounts receivable and inventory to support its sales, which could lead to an excessive amount of bad debts or obsolete inventory. As for Shopify, both their net working capital turnover and total assets turnover has slightly decreased in 2021. This means that it's taking longer for Shopify to recover its resources from its revenue generating activities. On the contrary, fixed turnover improved in 2021. Nevertheless, this financial metric is not as relevant for Shopify compared to other asset utilization ratios because their balances are smaller in relation to the company's total asset. Now let's talk about gross margin and net margin. These are profitability ratios used to assess the financial well-being of a company. Both are expressed in percentage terms and measure profitability as compared to revenue. Gross profit margin is the proportion of money left over from revenues after accounting for the cost of goods sold, which are raw materials and expenses associated directly with the creation of the product, excluding overhead costs. Net profit margin, on the other hand, is the percentage of income generated from a company's revenue. It takes into account all businesses' expenses and is therefore a more stringent metric by which to measure profitability. It reflects the total revenue left over after accounting for all outgoing cash flow and additional income streams. Shopify's profitability has dramatically improved over the last 3 calendar years. The pandemic has led to a surge in online shopping as people avoided going to physical stores. This caused Shopify's earnings to increase as more people used their platform to set up online stores. From a net loss of 7.91 in 2019, Shopify achieved a positive profit margin of 10.91 in 2020 and increased significantly to 63.20 in 2021. You have to note, however, that around 90% of the net profit in 2021 came from the unrealized gain in equity and other investments. Isolating the impact of this non-recurring item, the profit margin in 2021 could have been closer to that of 2020. Hence, the profit margin in 2020 is a more accurate measurement of Shopify's ability to earn from its ordinary operations than the profit margin that's reported in 2021. Thank you. Rain will talk about market value measures and dividends.
Hi, my name is Rain Cañete, and I will be talking about market value measures. There are many ways to evaluate a publicly traded company, but one of the most important is to look at its price to earnings ratio. The PE ratio is a measure of how much investors are willing to pay for each dollar of a company earnings. It is calculated by dividing current market price per share by the earnings per share. Shopify's PE ratio is 54.77, which means that the investors are currently paying $54.77 for each dollar of Shopify's earnings. This is a high PE ratio, but it is not unusual for a high growth company. For comparison, Amazon has a PE ratio of 64.4 and Facebook has a PE ratio of 24. One of the reasons why the PE ratio is such an important metric is that it can help us understand whether a stock is overvalued or undervalued. A high PE ratio might indicate that a stock is overvalued, while a low PE ratio might indicate that it is undervalued. However, it is important to remember that the PE ratio is just one metric and should not be used in isolation. Another important metric to consider when evaluating a company is its book value per share. The book value per share is the amount of equity that shareholders would theoretically receive if the company were to be liquidated today. It is calculated by dividing the company's total equity by the number of shares outstanding. Shopify's book value per share is $89.31, which means that shareholders would theoretically receive $89.31 for each share of stock if the company were to be liquidated today. This is a relatively average book value, which isn't too surprising given that Shopify is a high growth company. Shopify's cost of equity is 12%. This means that a company must earn a return of at least 12% of its investment project in order to create shareholder value. While this may seem like a high hurdle, it is important to remember that equity investors are taking on higher risk by investing in Shopify than they would be if they invested in a more established company. As such, they require a higher return in order to compensate them for this risk. Looking at Shopify's recent track record, it is clear that the company has been able to consistently generate returns that exceeds its cost of equity. For instance, over the past 7 years, Shopify share price has increased by an average of 104.7% per year. This means that investors in the company have been handsomely rewarded for the risk that they have taken. When valuing a company, it's also important to look at its market capitalization, which is a measure of a company's value based on the current market price of its shares outstanding. It is calculated by multiplying the number of shares outstanding by the current market price per share. Beta coefficient is another important metric when evaluating a company. Beta is a measure of a stock's volatility in relation to the overall market. A stock with a beta of 1 is considered to be as volatile as the market itself. A stock with a beta of 2 is twice as volatile as the market, and a stock with a beta of zero point 0.5 is half as volatile as the market. Shopify has a market capitalization of $155.1 billion and a beta of 1.82. This means that Shopify is slightly more volatile than the overall market, but it is still has been relatively stable company over the past years. The price of Shopify stock has significantly soared in the last 3 years, having grown to 10 times. From an opening price of 133 per share in 2019, Shopify traded at a closing price of $1,398 in 2021. This trend is consistent with the company's result of operation as discussed by my colleague in the profitability ratio section. The COVID-19 pandemic was undeniably a growth driver for Shopify as the world shifted heavily to e-commerce. Looking at Shopify's market cap can give us some insight into how investors are valuing the company and its future prospects. And while beta can help us understand how volatile a stock may be, it's important to remember that the past performance is no guarantee of future results. Looking forward, there's no reason to believe that Shopify will not be able to continue to generate returns that exceeds its cost of equity. The company is still growing rapidly and has a large addressable market. As such, it seems likely that Shopify will continue to create significant value of shareholder over the long term. When considering all of these metrics, it's important to remember that they should not be used in isolation. PE ratio, book value per share, cost of capital, market capitalization, and beta are just some of the many factors that should be considered when evaluating a publicly traded company. Now I will turn over the discussion to my colleague Christy for risk returns and the conclusion of the report.
Thank you so much, Rain. Hi, my name is Christy, and I'll be discussing the risks and returns of Shopify stock. So the first chart in the upper left of this dashboard summarizes the historical returns of Shopify stocks since its initial public offering on May 21, 2015. In the first year of being public, the company already realized a double-digit return of 84% on its stock price, and this even doubled in the years 2019 and 2020, when people turned to online shopping due to the pandemic. The second chart and the lower left shows the arithmetic and geometric average returns for Shopify. Arithmetic average return is the simple average return for a given period of time, while the geometric average return is the compounded return over that same period of time. As you can see, Shopify has an arithmetic and geometric returns of 104% and 93% respectively. Later, we will assess if this is above, at par, or below other market securities. Now, let's move on to the third section of this dashboard, which shows the variability of returns of Shopify. Using the historical returns of Shopify in the last 7 years, the calculated standard deviation is 72.64. A standard deviation is the most used measure of volatility. Simply put, it shows the range in which a stock price may increase or decrease during the year. In the upper right part of this dashboard is a Gaussian distribution of Shopify's returns. In a Gaussian distribution, or more popularly known as the normal distribution, most of the data are concentrated around a measure with a certain dispersion or variance. Using Shopify's arithmetic mean of 104% and standard deviation of 72.64%, we can build a normal distribution of returns for the company. This can be done by adding and deducting the standard deviation to or from the mean. So for the scale of 68%, the calculated variation of returns is from 31% to 177%. On the larger scale of 99.7%, the calculated variation of returns, which is plus or minus thrice the standard deviation, are negative 114% to 322%. While there's a chance that the higher absolute returns will be realized, there is lower likelihood from occurring as these returns are situated near the tail of the Gaussian distribution. Now, let's take a look at the average returns and standard deviation of consumer price index and other securities such as the short-term bonds, Canadian long-term bonds, and the TSX Composite Index, which is the benchmark equity index of Canada's largest public companies. As you can see, the returns of Shopify stocks are way above the other securities. However, the fluctuations in the returns are also drastic. This is proven from the calculated standard deviation of other securities, which are much lower than the 72.64 of Shopify. As you can see, for consumer price index, it only has 0.9 standard deviation compared to the 72.64 of Shopify. Moving on to the next slide, we can conclude, based on the foregoing discussions, that Shopify is a high-growth company. It provides high returns and is a volatile or risky investment. It's a high growth since it's investing heavily in new initiatives, which in turn provides higher earnings per share. While the company is not currently paying dividends, the increase in share price alone is already providing significant returns in the form of capital gains. But the returns are very volatile, which makes Shopify a risky investment. Recently, in June 2022, the share price is already trading at a range of $300 to $400. This is a very huge drop from the 2021 closing price of $1,398 per share. While there are systematic risks in the market, such as the current inflation and interest rates, Shopify's drop is way above the market. This is consistent with our conclusion that Shopify is a risky investment, since it has also significant and systematic or asset-specific risk. So that ends our analysis of Shopify's financials. Hope you enjoyed listening. Thank you.
Thank you so
Thank
much.
you.
Thank you.